Hello, everyone, and welcome to the Retirement Planners of America podcast, our weekly market alert video. And as usual, we are going to have more fun than a human being should be allowed to have when talking about all of this boring financial stuff. So, let me go over with you what we're going to talk about on this, our weekly excursion into the land of personal finance, retirement planning. So we have a lot. We have several topics. The first one is that the inflation numbers came in, and they actually came in where inflation went up. But the market said that's good news because the Fed's now going to lower interest rates. Well, that seems to be counterintuitive. Why is that the case? So we'll explain it, and more importantly, what you should do about it. Also, we're going to look at what could be driving the stock market, which is earnings. And then also, we're going to talk about the difference between market and economic sentiment and the mountain of cash that is sitting out there that could drive this market to all-time highs, but could also cause the market to crash. So, how do we juxtapose those two things? So, I hope this video finds you healthy, wealthy, and wise. And also, before we get started, one of the things that I want to express to you, I am Ken Moraif. I'm the founder and CEO of Retirement Planners of America. And we are a firm that specializes in working with people who are within 5 years of their retirement or who are already retired or in the first 5 years of their retirement. So if you're in that decade, then that's who we specialize in working with. And I'm going to make you an offer. If you come in and visit with one of our retirement advisors, we'll build a plan for you at no charge or obligation. In our first meeting, we'll get to know you, understand where you are, how you're invested, what your goals are, and then we'll invite you back for a second meeting. At that time, we'll have specific recommendations for you, and we'll go over any costs involved in implementing what we have talked about. Now, at that point, if you decide you want to work with us, that is fantastic. And if not, that's fine too. Either way, there's no charge, there's no obligation, and we will part friends. So I encourage you to take advantage of that opportunity. It's all at rpoa.com, which is our website. Okay, so let's get started. Jordan, why don't you join us? There he is.
Did I miss a memo here, Ken?
Oh, it's true, isn't it? I'm actually at a wedding in Charleston, and I was also
Uh-huh.
at a convention, not a convention, a business conference in New York with all these highfalutin CEOs of all these companies like ours. And so I don't know why I get invited to those, but it's these companies. Like one of them has $1.2 trillion of assets under management. Trillion with a
Wow.
T. And so, little
That's a
I'm
big
like
boy
little
there.
old me. What am I doing at this conference? But I'm flattered that they invite me. It's nice. Apparently, they
Sure.
feel that they can learn from me, but I learn more from them. But nobody wears a tie at that thing, so I didn't take my tie, and now I'm here at the wedding without a tie.
Okay.
So I'm glad you're wearing yours.
So CEOs and people who go to weddings don't wear ties, huh? Okay. All right.
Yeah, and underlings do.
Yeah.
So, in case you
Apparently,
guys
we've
don't
made
know,
that
Jordan is
clear.
our chief investment officer, and so thanks for joining us. So, let's talk about inflation. It went up. So, inflation went up versus last year, but it went up less than expected, and so therefore that is good news. So, it went
Yeah,
up,
it's a
which is
weird thing.
bad news, but less than expected, which is good news. And everybody's hanging their hat on the less than expected than the fact that it went up.
I mean, it's a weird thing to try to swallow and understand, right? That prices are not going down, folks. We've all seen that pretty heavily since the pandemic. But again, how the market views this, how the Fed we think views this is it's relative to expectations, right? So we actually don't really want deflation. Deflation usually means bad things economically, but we do want some meaningful growth, that's subdued, and we gotta have that. So the market goes, all right, still this whole bugaboo that they've been worried about with prices going up and up and up, it's really not happening. So that probably is good.
Yeah. And the reality is that even if inflation went down to 2%, which is what the Fed wants, it still means prices are going up,
That's right.
right? I mean, if it doesn't mean inflation. So deflation is when prices start going down. And as
Yes,
you said, deflation is like a cancer to an economy, and we don't want that, believe it or not.
we don't.
All right, so the Fed then should lower interest rates despite the fact that inflation went up versus last year, but less than what was expected.
I mean, that's the thinking, right? So if you look across market and economists and surveys, they would think that this reading, and there hasn't been a lot of data come out since the government shutdown, but this is one of the important ones, certainly the Fed would be monitoring, would take this to say, again, I don't know how many of these they need to say inflation's not a real persistent problem right now. But surely this would be give them enough to say, yes, we're going to lower interest rates next week when they meet. And now, still, the majority think that maybe December, that would be the time the next month they're meeting, we could see another cut. So we'll see what happens here. But this would certainly think that the market would go, okay, Fed, don't worry about inflation as much. Let's stay focused on jobs.
And with the government shutdown, basically this is the Fed, right? They're
That's
operating
right.
with like no data, and maybe
But
that's
maybe that's better. Maybe that's
yeah.
better as we've talked about. Maybe that lead to better decisions. We'll see.
Yeah. And as we've talked about, a lot of the data is wrong anyway. They adjust it, a year later and say, oh, by the way, the jobs numbers were off by 1 million jobs. And so the decisions they were
Right.
making with the data was like wrong anyway. So maybe it's no difference. But let's talk about earnings. So earnings are looking really good. And as we always say, what drives the stock market is earnings, right? In other words,
Mhm.
profits that companies are making drives their stock price, regardless of what the economy is doing or what inflation is doing or all of that. If a company has really good profits, their stock price most likely will go up and vice versa. So right now, earnings season, things are looking,
So far, so good. I mean, again, we're not all the way through it. We've seen a couple big names, especially on the banking side, come out and they looked good. Some other healthcare names look pretty good. Now we have Apple, Microsoft, Google. Those will come out next week. But again, I think largely based on the kind of the trend of earnings growth, I would expect that to be pretty good. So, fundamentals look good, look healthy. And
yeah.
that's a huge important driver for market returns.
Yeah. And AI, we just heard, for example, that Facebook, I think they said they're going to lay off 600 people because AI is doing the work that those people were doing. We heard that Salesforce laid off like 1,000 people, I think it was a couple months ago, because AI is doing the work of all those people. So, the
Hmm.
Fed is supposed to be worried about, jobs, but how do they incorporate the fact that the jobs are disappearing not because the economy's bad or because companies are not they're not profitable and they're laying people off. It's because AI is like taking over all these jobs. So the Fed has a difficult job because they've changed their focus from we're worried about inflation to we're worried about jobs. But maybe the reason why we're seeing jobs not looking so good is AI, and it's not because there aren't a lot of layoffs, right? Or people aren't hiring right now. That's the thing, right?
That's it, right? We're not seeing tons of layoffs, right? A little bit, like you said, related to AI. It'd be more on the yes, on the hiring side, and a lot of these companies are not hiring either. So
Yeah,
what it
there's
all means, I don't know, but I think that's where the Fed's going to have its eye on.
yeah, they're looking at I don't need to hire more people because I can do AI. I can have AI do the work of that. And so, I have loyalty to my existing employees, but I'm not going to hire any more because AI can do that. So that's a reverse way that AI is affecting the jobs market. All right, so let's talk about this is really interesting, and you and I were talking about this before we started, and that's the difference between market and economic sentiment. So right
Mhm.
now, well, you tell us what is the difference between market and economic sentiment?
Yeah, it's really interesting. So, economic sentiment, if we were to talk to a lot of our clients, prospective clients, advisors, if we're reading news, there are a lot of fears out there about the state of the jobs market, the economy, geopolitical risk, straight political risk. And so there's a lot of people that are worried that at some point this is going to fall apart, right? There are going to be cracks in the system. We're at kind of the end of the cycle. And that is kind of economic sentiment, right? Which is like lingering fears that permeate out there. And what that typically does, it leads people that have to start hoarding, stashing cash for the unknown. Right? We don't want to reinvest because we don't know what's going to happen in the future. So they start piling up their cash savings. Now, market sentiment is different. Market sentiment, we look at that and say, okay, you could look at just the state of where the market is, which is towards all-time highs, and say, well, that's probably a pretty good indicator where things are, how people are feeling. You can look at, are people putting more and more money into the market? And you can look behind the scenes of the market and say, are people starting to hedge their bets, expecting maybe the market to decline? But we see the opposite there, actually. Right now, there's almost some complacency inside of how people are positioning inside of the market. So you got people that are very bullish, optimistic on the state of the market, while another side is very worried about the state of the economy. And so
So
it's like, which one's right?
you're probably too young to remember Welcome Back, Kotter. You remember that show?
I do not remember that
No,
show.
you don't. Okay. Well, this was John Travolta's first role that made him famous before Saturday Night Fever turned him into an international star. And he was
Okay.
kind of like the unintelligent but very good-looking guy in this high school class, right?
Okay.
And he always would say, "I'm so confused."
I'm so confused.
And so it sounds like that's what's going on here. It's like, I'm so confused. But the
Yeah.
good news, though, is that there's lots and lots and lots of cash. And as soon as those people that are confused, if they think that the economy is going to be okay and we get past these lingering doubts, there is a mountain of cash that could go into the market and drive it to significant new all-time highs. So we remain bullish given all of those dynamics. But again, it's like you plan for the worst and you hope for the best, and that's why we're all in right now, right? So we're
Hmm.
anticipating that it's going to go up to new highs throughout the rest of this year and into next. But at the same time, we have our invest and protect strategy to protect us should the market collapse because all of this is a house of cards, all this AI and all this other stuff is another Y2K that's brewing.
Yeah. I mean, that's right. I mean, right now, what we don't have to do with our strategy is hoard cash because we're worried about the unknown. Right? We have a strategy that would just deal with that. So that would allow us to kind of stay invested, be confident, and deal with the now versus what is to come. And then if the what is to come does happen and this stuff falls apart, right, we have a way to deal with that. And I think that's the hope. If we just talk about through the end of the year of how this economic sentiment flows into market action, the hope would be, like you said, is people say, okay, the Fed is starting to bring down rates, money supply opens up, credit facilities open up, and people that have been hoarding cash say, okay, I feel better. Let's go ahead and invest now. And then that maybe leads to the next leg higher. And that's what we hope happens.
Yeah. And one of the things I think that is keeping people back is they're not convinced yet that, the effect of tariffs has been fully felt. It's like every time we get a new inflation reading, we're like, okay, inflation isn't that bad, but tariffs are going to cause inflation.
Right.
And so wait till the next time and then you'll see it happen. And it just hasn't.
That's
And so,
right.
so there's that lingering doubt. At some point, I think that rubber band is going to snap where people are just going to say, you know what, tariffs are not inflationary as we worried about. People are absorbing those costs. And therefore, I'm going to go ahead and release that fear and go into the market. So, ladies and gentlemen, we are confident that the future looks bright. In fact, I have this thing from this old song about the future's so bright, I got to wear shades. So I'm going to put on some fake shades here. But only because
Yeah.
we have our invest and protect strategy. And should the market turn the other way, I hope you have the confidence of knowing that we will take action to protect against a big bad bear should that occur. So, as usual, I hope you had more fun than a human being should be allowed to have when talking about all this boring or listening to all this boring financial stuff. I hope this video finds you healthy, wealthy, and wise. Make sure you like and subscribe and you share it with all of your friends and business associates. And I look forward to seeing you next time, and we'll talk soon.
Retirement Planners of America.